Hello, everyone, and welcome back to the Trading Table. This is Andrew, and joined with me is Landon. And today we're going to be going over what options really are. We have a bunch of new users here in our Discord, people who are new to trading. Some might have traded stocks or other things before that. But, even if you are a seasoned investor, this could help you. Because there's a lot of things that even good investors, good options traders don't know, and that good options traders overlook. So today we're going to be going over everything there is to know about options trading in a concise way and in an English way. Because I've seen other videos on YouTube where they go over what are options, and it's literally like they are talking like a robot. It sounds AI generated. It sounds terrible. So we're going to be going over it in English today. For you guys here. So, what are options? What is the basis of an options contract? So, options give the buyer, let's just say in this scenario that you are the one buying it, so you are the buyer, the right, but not the obligation, to buy or sell a stock at a specified price, which is the strike price. We'll be going over the strike price later in the video, so just follow along here. Now, options contracts have an expiration date, right? So, in simpler terms, you're basically buying a contract, whether it be calls or puts, and we'll go over that as well. So don't worry that, if it's calls, the stock will go up, and if it's puts, the stock will go down, right? It's very, very simple. The technical definition really doesn't apply that much, like the right but not the obligation. That might sound a little bit confusing, but you basically are buying a contract and hoping for the best, right? That it will go up or down depending on your sentiment. So you're technically purchasing 100 shares with an options contract. So if we look at Robinhood here, we can see that it says 100 shares, right? So you're purchasing this contract that gives you the right, but not the obligation, to buy or sell a stock at a specific price for 100 shares. And there's this thing called bullish or bearish. I'm sure you guys have heard of it before. Bearish is that you want the market to bear down, right? If you're a bearish investor, you want price action to drop. So you want to see red candle after red candle. That's like your best day for you if you're a bearish investor. You want the market to go down, right? If you're bullish, you want the market to go up. You want to see green candle after green candle and just a nice trend upwards. So bullish and bearish, just some good terminology to know as a lot of traders use it, right? So just keep following along. We'll go more into what calls and puts are, strike price, premiums, and all that. Any thoughts here, Landon?
Yeah, Andrew. So for starters, a call is for bullish investors, and then a put is for bearish investors. So a call, you're basically calling that the stock will go higher, and then a put, you're putting the stock down. The strike price is the set price at which you can buy or sell the stock with your option. And then the expiration date is the last day you can use your option to buy or sell the stock at the strike price. After this date, the option does become worthless.
Yeah, and the expiration date is very important. In a second here, we're going to go over something called the Greeks, and there's this thing called theta. Um, and we'll go over it more, but for now, just keep in mind that the expiration date is very, very important in options trading, right? The more time you buy, the better a contract is, right? Um, and calls and puts, right? Calls bullish, puts bearish. You want the stock to go up, you run calls. You want the stock to go down, you go puts, right? Very, very simple. Another terminology thing that is very useful to know is premium. And a premium is how much a buyer pays for the contract. So obviously, options contracts cost money, right? And if we look at the options chain on Robinhood here, you can see that, there's a price right there, right? In that red circle. And that price is the premium. So it says, for example, if it said 2.93, right? The price per contract, or if you will, price per share, and remember, you're buying 100 shares of this in the contract, the price per share is 2.93. So the price per contract on a premium of 2.93 would be $293, right? So you have one share, 2.93, and then 100 shares, 293, right? You literally just are multiplying it by 100 and moving that decimal 2 places over to the right. So very, very simple, right? The premium is just how much you pay. Moving on to something a little more technical now. And I see that even a lot of seasoned traders don't truly know what this means. Some might have, an idea, like everyone knows, what theta is. But if you're a beginner, you have no clue what any of this is, right? So the Greeks are very important. So delta measures how much the options price changes when the stock price changes, right? So for example, a delta of 0.5 means the options price will move $0.50 or 50 cents for every $1 change in the stock price. So if you have a Microsoft contract and Microsoft's price is at 400 and you have a delta of 0.5 and Microsoft goes up to $401, right? The options premium, so the premium that you paid, will increase by 50 cents. So, delta can give you a good grasp of how much your premium will increase every time the stock goes up. So moving on to our next one, we have gamma. And gamma measures how much the delta changes when the stock price changes. So the delta is not a set rate. The delta is subject to change. So the gamma shows the rate of change of the delta and helps understand the stability of the delta. So if a stock has a gamma of 0.10, right, which isn't high, it's relatively normal, then for every $1 move in the stock price, the delta will be adjusted by a corresponding 0.10. So if we look at Starbucks' options chain here, right, we can see that the 81 call expiring June 7th has a delta of 0.39 and a gamma of 0.16. So the delta 0.39 means that the options price will move 39 cents. So 39 cents will be added to this for every $1 change in the stock price. And it's important to remember that this delta, right, of 0.39 is added to this. So a delta of 0.39, right, is added to this 0.70 premium. So this would be $70, right, because you're paying for 100 shares, and a delta of 0.39 is added to this. So if Starbucks goes up from 80 to 81.10, this options premium will be about $109. So that is added to each share, and you're purchasing 100 shares, right? The gamma here means that for every dollar that Starbucks moves up, so if it moves to 81.10, then this 0.16 value will be added to the delta. So if it goes up to 82, now it would be 55, a delta of 0.55, right? So 82 now, you're looking at $55 return, right? So the gamma is really just how, it is kind of tied in with the delta, and it tells you how the delta moves, right? And then we have the theta, right? The theta, in my opinion, is probably the most important Greek. It's the one I use the most. It's the ones most options traders use the most because it is very, very important. The theta measures how much the options price decreases as time passes, which is often called time decay or theta decay. For example, a theta of right here, negative 0.08, means that the options price will drop 8 cents each day. So if we go to the Starbucks contract that we called in our video, right, we can see that, till expiration in January 17th, 2025, right, we have kind of a curved line here. So at a price of 80, let's say Starbucks stays at 80 for the rest of this options contract's expiration. So for the next almost about a year or 8 months or however long it is until January 17th, 2025, it stays at 80.10. On June 27th, which is in about 26 days, this contract will be worth 0. So as you can see, if the price stays the same, it'll decay, right? It'll decay over time. And that's how you get the break-even price. So the break-even price for the Starbucks contract, the 82.5 call expiring January 25th, or sorry, January 17th, 2025, is 88.25, right? And that's because this, as you can see, this is a curved line, right? The more time goes on, the more the options contract decays, right? And this options contract has a crazy amount of time to it. So the theta is relatively low. And as we can see here, that if Starbucks were to hit 88.25, tomorrow or right now, it would be worth $575. But if it's at expiration, it's worth nothing. Or just, you break even, right? $0. So we can see the difference here in the options chain between a theta of a contract expiring January 17th, 2025 of negative 0.01 and the theta of, an options contract expiring this week, right? If we go to the 82 one here, we can see it has a theta of 0.06, which might not sound like a lot more, but you know what? The theta, will increase each day. So on Tuesday, it'll be more. Wednesday, more. Thursday, more, and so on and so forth, right? Next, we have the Vega. And the Vega measures how much the options price changes when the market's volatility changes. So, for example, a Vega of 0.1, or in this case, 0.03, means the options price will change 3 cents for each 1% change in volatility. The Vega does not matter as much, especially if you're a beginner. So do not worry about it too much. It is good to learn. So, definitely learn this and understand this, but it's not like something that we use, honestly, every day, right? It's very, very technical when we use it. Same with the RHO, right? The row. That measures how much of the options price changes when interest rates change, right? So, 0.003, the price will change $0.003 for each 1% change in interest rates, right? Literally does not matter. So do not worry about the last two, the Vega and the row, don't really matter. The main ones you kind of have to focus on are delta, gamma, and theta. And even the delta and gamma, if you're just making a day trade, don't even worry about it, right? Really not much to worry about there unless, you check it and, the delta is like 0.001, which I've never seen before. But, it's good to always check and get a grasp of what's going on.
Yeah, so at the end of the day, those are basically just indicators for the option contract. So I wouldn't stress too much about them. But another thing that a lot of new option traders find very confusing is the break-even price and why it's different from the strike price. And this is mainly because of theta decay, right? So the longer you hold on to that option contract, that contract is gonna be affected by theta decay. Therefore, depending on whether you bought a call or a put, the contract's gonna need to be valued more than the original strike price or valued less than the original strike price. But playing off of that, another factor is implied volatility. And this is a measure of the market's expectation of how much the price of the underlying asset will fluctuate over a specific period of time in the future. Um, Higher IV tends to make premiums more expensive, and lower IV tends to lower premiums.
Yeah, Landon. And, as you can see here on the Starbucks options chain, right? You have a call for 82 and it says the break even is 82.36, right? Well, that's not a very big difference, as you move to other stocks with higher implied volatility and higher theta loss, right? The break even definitely starts to play a big factor. So keep an eye on that and always understand your expiration dates and your theta decay. But, jump into some risks now because a lot of people do not trade options due to the risks. And, that's kind of just not, people have a lot of, misconceptions about options trading. That it's very risky, which, it is risky, but there are ways to manage risk, right? And keep your risk levels low. It's good to know what your risks are, right? So you can lose the premium, right? You can't lose more than that. So if I buy this Starbucks contract for 82 strike, and it's 0.39 per share, the most I can lose on this is $39. You will never lose more than what you pay for the premium. And, a lot of people, I feel like, have a misconception with that, right? That, you can lose everything, right? Like, oh my God, like I'm going to lose my whole account. That's not true at all. The only thing you can lose is the premium. And there's ways to leverage this risk, right? We'll go over some risk management strategies later in the video, but for now, I just want everyone to understand the risks that come with options trading. So options can amplify losses as a small change in the underlying asset's price or the stock's price can lead to significant losses, right? Like if you have 15 contracts of this and it goes down 5%, obviously you're going to lose a lot, right? So, never good to over leverage, which is one of the strategies we'll go over later in the video. But, options are also complex, right? Not a lot of people, are willing to learn or have time to learn them and all their mechanics, which is why we also made this video. So, the more you understand something, the better you become at it, in my opinion. So, options contracts are pretty, complex and can definitely get a little, scary. Time decay, right? We went over the theta a million times, but time decay is another risk because, you have a clock basically running after you. So you got to always, remember that you have an expiration date, and if it hits that expiration date, it's worthless, right? Market volatility. So market volatility can, if you have puts and some volatility comes in and it's bullish volatility, remember bullish is, market going up, then, that could really mess you up, right? If you, are trading and a huge green candle comes in, right? Some volatility like that could really mess you up because, how fast can you react, right? So, another strategy is always important to set stop losses, which we'll also go over later in the video. But liquidity risk is also a big one. I've seen some people have issues with liquidity when they go to sell their options. And if there's no buyers, your option will not sell. There's not a magical pony that comes in and buys your options contract, right? In options markets, you have a buyer and a seller. So someone is actually buying the contract that you are selling when you sell it. So I've seen people like with, NVIDIA calls for like $1,500 and it jumped over like 20,000%, right? And there's just no buyers there. Like nobody's really like buying 1,500 call for the end of the week. Like it doesn't make sense. It's very unrealistic. So that options contract just ended up not selling. So you just want to be careful. Don't just go buy some random stock with terrible volume because you won't be able to sell your contract. Execution risk is, rapid price movements. Like I said, the volatility, it can prevent the execution of orders, especially on Robinhood. Right? If you're using like a paid brokerage, which I'm sure if you're a beginner, you're definitely not. You're using some, Robinhood, Webull, maybe Thinkorswim if you're a little more advanced. But, Robinhood is notorious for its terrible fills, right? It takes a while to fill, especially if there's a lot of volatility, right? Like I said earlier, if there's a huge green candle and you're clicking sell, 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 there's a pretty high chance that it won't sell just due to the limit price and fluctuating movements, right? But moving away from our risks now, let's tone it down a little bit. We have things called in the money, out the money, and at the money, right? So this is also just good terminology to know. So you know what? We've been using Starbucks all day as the example. So Starbucks is currently at $80.10, as you can see up here. And if we move right down here, we can see that 80 would be at the price or at the money, right? This is very, very simple. 81 would be out of the money because it's, out of the money, right? It's very self-explanatory. And then 79 would be in the money, right? So 79, if you are, and this is different for calls and puts, right? So 79 is in the money because it's lower than 80, and you're saying that this call contract will go up. You want this stock to go up. So 79, you're already in the money, right? If we take a look at puts here, it's reversed, right? So $80, right? So 82 would be in the money. If you're, stocks at 82 on Starbucks, right? Let's jump over to Starbucks' chart real quick. If you're at 82 for puts, you're already in the money, right? Because, it's saying that it'll just go lower than this line right here, right? It's saying that the price will be lower than this. So you're already in the money. And same goes for out of the money, right? If you want it to go lower and you have a strike of 79, that's out of the money because you need it to drop to 79 to be in the money.
Yeah, Andrew, that's all really great advice. We had a question from Jay. They were asking where they could do paper trading, and here at the table, we recommend Webull. They have free paper trading, and then we also recommend Thinkorswim. That's through Charles Schwab. Personally, my favorite, but I know Andrew loves Webull. So yeah, it's really up to you at the end of the day. But those are two great recommendations from us.
Yeah. I mean, Webull just has an easier UI. So if you're a beginner, right, it'll be a lot easier to use Webull. But learning Thinkorswim has endless benefits if you're willing to, fight through it and learn. It is very difficult to use. I even still struggle to use it sometimes, but I have not mastered it yet. But Webull definitely the easiest free option if you want to start paper trading. But like I said earlier, I'm just going to jump into some quick risk management strategies to tone down your risk, right? So the first one is always having a stop loss, right? This can be a percent of if the contract goes down. This can be a price level on the chart. This can be the price of the premium if it drops to this level, right? I've seen it all. So stop loss is basically just managing. Like, let's say if you enter a call and it just starts dropping, right? And then you'd say if I'm down 20%, I'm going to cut my losses and I'm going to stop out, right? That's what a stop loss is. It's very important for risk management. You always want to have a stop loss, right? You don't want to pay $200 for an options contract and just sit there and hold it, because it's either you lose 20% of $200 or you lose all of it. So, stop loss is very, very important. Another thing is utilizing support and resistance. And I'll put a card in the top right or top left, depending on what you're on the screen right now for our support and resistance video. But, support and resistance is great. So you can see a window. So that's another way to use a stop loss, right? You can say like, if, this breaks below this support, like, if we take a look at AMD here, we can see that, let's say we loaded up calls in this dip right here, right? Like we saw, okay, it's going to bounce off this and come back up. If it broke through this support and started moving down, like, okay, I'm stop lossing out. And that would have been a great decision here because you could have lost a lot of money. And same goes for resistance. If it breaks above a resistance like it did here and you had puts, you could stop loss out right here. So it's just another way to just manage your risk, right? Another one, and a very, very common mistake that I see, is people over leveraging, right? People will have $500 accounts and will risk all 500 on one trade. You do not want to do that. That is a very quick way to make a recipe for disaster. You over leverage, right? Let's say you over leverage, you dump 500 into a contract, and you lose it all? That's it. Instead, put a little here, little there, manage your risk, right? Do not just dump all your money into something at once. Definitely do not over leverage. A good rule of thumb is only using like 20% of your account in an options trade. So that's a good, thing to keep in mind there. And the next one is to have a plan, right? Having a plan is probably one of the most important ones because it's very broad and covers everything. A plan can include a stop loss. A plan can include a take profit, right? So we'll use, the AMD chart here again because we're already here. Let's say I loaded up calls right in this area right here. And you know what? I put my stop loss down at this 161 support, right? Or, you could call it about like 161.06, right? You had a little bounce there. So my stop loss would be down here, right? So we have our stop loss, or SL. A lot of traders use that terminology. So we have our stop loss down here, and we have our take profit right here, right? So we could say that, if it jumps up here, I'm selling the contracts and I'm taking profit, right? You want to stick to that, okay? A lot of people get greedy and they lose. So you know what? It's better to secure what would be like, this would be like over 40% in profit than to, just sit there and then hold on to it. You're like, oh, I wonder what it'll do tomorrow. And then tomorrow AMD could literally just go straight down, right? So you never want to be greedy with options either. That's a good way to burn yourself. And I've seen that happen to people before where they were greedy. They're like, okay, I'm going to hold on to it and I'm going to do this. And it just ends up, not working out at all. And looking at the stop loss here, you know what? I went over stop loss already. So if it broke down, you'd sell. You're not going to sit there and hold, even if it comes back up. And that's something else you also want to practice. You want to practice emotional trading. So if you sell right here and, right, you're like, oh man, I wish I held. It went all the way up. I mean, look on the bright side. You secured 40%, right? You made money. It was a good play, and you stuck to your plan. And that's exactly what you should do, right? Just imagine, it breaks above here, right? You're like, oh, it's about to go up. I'm going to hold on to it. Boom, shoots down. And you're like, wow, I really wish I had stuck to my plan. So, always stick to a plan. And then, the next one is you got to always stay informed and attent, right? I remember I made this mistake, and I'm not afraid to admit that, right? When I wasn't able to trade full time, I would, be trading off my phone, and I wouldn't be fully attent to it. I'd be doing other things. And, like a stock, I'd enter puts, and it would have a move like this, and I wouldn't be attent. I wouldn't be looking. It would hit my stop loss, and I'd get a notification on my phone, but what's a notification going to do if I'm doing something, right? So you just always want to stay attent. And I know that some of you may have jobs and whatnot, but, setting alerts is a great way to mitigate that risk. So you just want to always, have it in the back of your mind, like, all right, if my phone, buzzes in my pocket, just pull it out, check it real quick. Stop loss, no, we're good. Stop loss, yes, I gotta get out of this. Or even for take profit, set a notification for your take profit, right? So there's a lot of ways you can trade, even if you have a full-time job, right? I personally used to trade during school. So did Landon, right? So there's a lot of ways to do it, and there's a lot of ways to stay informed and attent. You just have to kind of put in the effort, right? And you always want to review your strategy. You don't have to. I mean, you can. You don't have to, though. You don't have to keep the same strategy for every single play, right? Like for this, if I wanted to be more risky, I'd put my stop loss all the way down here, right? And I'd put my take profit like up here. You don't have to stick to, oh, I'm just going to take 40% and run, or, oh, I'm going to have a 20% stop loss. Although it's recommended, you don't have to do it, all right? And the next thing is keep your losses small and your wins big, which I know sounds very unrealistic, but, just respect your stop losses, respect your take profit, and I promise you it is not hard to win in the options market.
To finish it off, here's a list of our favorite brokers. We have Charles Schwab, TD Ameritrade, although I do believe they merged, or Charles Schwab bought TD Ameritrade, Fidelity, Bank of America, Wells Fargo, Webull, E-Trade, and Interactive Brokers.
Yeah, and if you're looking for the easiest two, Robinhood, Webull. All right. As you get more advanced, Interactive Brokers, TradeStation, Thinkorswim, you could start considering. But yeah, that's all for today, guys. Thank you so much for tuning into the Trading Table. If you have any questions about this video, please feel free to join our Discord. Me and Landon are on it 24/7, responding to questions, anything you guys need. So be sure to check out the Discord. The link is in the description. And we'll see you guys tomorrow for our Sunday stock recap and our week outlook.